Watch me close this. Watch me close this. Cause I am a closer. I'm a closer. That's a little confidence dance you do before you close.
Hello?
Yeah, I'm here. You here?
Yeah.
You guys hear me okay?
All right.
Yeah. So was Jacqueline on speaker yet?
Yeah, I can hear you.
Okay. Perfect. Hey, I'm glad you made it home safe. So I'm what's called a medical field underwriter. It's kind of like a national broker, but it allows me to shop all the A-rated carriers nationwide. There's about 63 companies I look at, companies you've heard of, like Mutual of Omaha, Transamerica, Aetna, Aflac, et cetera. The list goes on. I'll spend about 3 minutes on some medical questions. And then based on your age and health, that's going to let me know what you guys qualify for at the lowest cost. Is that making sense?
Yeah.
Okay, perfect. And then today's appointment's for mortgage protection, but I also specialize in retirement planning, life insurance as well. Have you guys ever looked into mortgage protection before?
No.
Okay, well, we'll kind of explain a little bit about it. It's a very popular product, if you can qualify for it, but what it's designed to do is protect your biggest asset. So I see your loan's at $276,000. What's the house appraised at?
The house appraised at 340.
340. Okay. So 340. So if you sold it today, give or take, you're going to have about 65,000 left over, right?
Yeah.
Okay. And then do you guys pay car insurance right now?
Pardon me?
Do you guys have a car with car insurance?
Yeah.
Okay. Well, this is kind of similar to that. So we pay our car insurance protecting an asset that goes down in value versus up in value. Okay. So right now you have 65,000, but let's fast forward 15 years. Let's just say we pay that house down to 150 for easy math. And let's just say the value of your house goes up to 400,000. Now, more than likely it's going to go up more than 400,000, but just trying to keep the math easy here. So if I sold for 400, I paid off my loan of 150 in 15 years. I'm going to have 250 left over. Does that make sense?
Yeah.
So we have a growing asset going from 65 all the way to 250,000, 300,000, 400,000, up and up and up as time goes on. Now a car, unless you got a classic Ferrari, it's probably not going to go up to 250, right?
Right.
Yeah. So most people want to protect their asset in case of a death, illness, what have you. Make sure the bank has no chance of taking that asset away from you guys. Okay. So I got two ages on here. I got a 66 and 60. Who's who?
I'm 65. She's 50. No, 60. I'm 50. I'm 55. She's 60.
Okay, so she is
65. She's the other one.
She's 60. Okay. So we got Jacqueline at 60. We got Jerome at 65, right?
Yes.
Okay. And then are you guys both working or are you guys retired?
I'm retired. She's still working.
All right, retired for Jerome. And then how much do you bring in monthly for your retirement?
My retirement, 2,800.
2,800. And then for you, Jacqueline, what do you do for work right now?
Oh, she went upstairs. She went down. She works at Verizon.
Verizon. All right, and I do need Jacqueline on the phone or we can't do the appointment.
Okay, when she said to dad, come to get the boy.
Oh, gotcha. You guys watching your grandson?
There she go.
What was the question?
Oh, I was wondering how much income you make monthly at Verizon.
4,500.
About 4,500. Okay. Now, obviously, Jerome, you don't have any protection in place in case you can't work because you're retired. But Jacqueline, I'm guessing you have some disability through work, right?
Yes.
Okay, good. So, the question is, if something happened to Jerome, God forbid, heart attack, car crash, something like that yesterday, losing 2,800, you probably can still afford to stay there, but it's going to make bills a lot tighter, right, Jacqueline, for you?
Right. We hear you.
Okay. And then if something happens to Jacqueline, that 4,500 is going to definitely make it a lot tighter for you, Jerome, for sure, right? Okay. So let's see if we can figure out a plan that fits the budget. And then that way we can make sure we don't have that kind of tightening up. What's your guys' monthly mortgage payment right now?
22.
2,200?
Mhm.
Okay. So definitely Jerome probably wouldn't be able to stay there then if something happened to Jacqueline. Okay. All right. So all the plans I'll go over with you. They're not something you can buy. You do have to be approved for them. So if you guys see a need for it, like most people do, my job's pretty simple.
Be quiet. I'm sorry, what you say?
I just said my job's pretty simple today. It's just to help you guys put in a request for approval. And the insurance company gives us an answer if you're approved in about 3 to 7 days, because it's not something you can buy. You do have to be approved for it. Okay. So if we get approved, which is the goal, you'll have 30 days to adjust your policy up or down. Okay. Does that make sense?
Yes.
Okay. So I'll give you a couple different plans. If you're not sure which one you want, just know we got 30 days to adjust it. Okay. Okay. Now, if you guys don't want a policy, just let me know. We'll close the case out. We don't do second appointments since we're going to shop every carrier nationwide, and we won't even know if you can get it until we apply. Okay. Any questions on that?
No.
Okay. Now, for that approval process, Jacqueline and Jerome, there will be 3 required things. I don't need them now, but I just want to make sure you have them on you that we can grab later. Okay. They will ask for a driver's license, a social, and a routing and account number to pay for the policy, if approved. They do not take debit cards because they're not secure. Routing account numbers are, because they've been handed out on checks to strangers for the last 60 years. Okay. We can't buy anything with those numbers. Does that make sense? Okay. And then do you have those 3 things on you we can grab later?
Yes.
Okay, perfect. Well, let's get into some medical and then we'll kind of see what options are available to you guys. Jerome, what's your height and weight?
My height is 5'11". My weight is 185.
All right. Smoker or non-smoker?
Non-smoker.
Okay. And then Jacqueline, height and weight?
5'2.5", 151.
And smoker or non-smoker?
No smoker.
Okay. And then Jerome, when they pull your prescription record, what prescriptions will it show that you're currently taking?
Taking I'm taking aspirin, I'm taking high blood pressure pill,
Okay.
and I'm taking a metformin.
Okay. Metformin. So we got the baby aspirin, we got the high blood pressure pill, metformin. So just 3 of them, right?
Yes.
Okay. And then they look back 10 years at prescription history. Anything sent to the pharmacy, they'll see. Was there anything you used to take that you no longer take now?
No, just them.
Just those? Okay.
Mhm.
And then Jacqueline, what about for you on prescriptions? What will they see on your record?
She's going to look at her medicine. The pill.
Okay. Yeah. Just let me know when she's back. I'll write them down. How's your grandson, Jerome?
He's fine.
Oh, I said, how old is he?
Oh, I'm sorry. He's 6.
6. Okay. Keeping you busy, huh? Running around the house?
Oh, man.
Well, mine's 15. I don't know. My 6-year-old was easier than when he was 15. Now he talks back to me.
Okay, get all together. She's taking metformin.
I'm taking metformin, aspirin.
Okay.
I'm taking statin,
Statin for cholesterol. Okay. Anything else?
and that's it.
Okay.
Metformin.
All right. So the big ones are the metformin, the statin. So it's just really 2 a day, right? And the aspirin. I guess 3 a day.
1 a day.
No, but 3 total medications, correct?
Yes.
Okay. And then looking back 10 years at history, anything you used to take, you stopped taking?
No.
Okay. I'm going to go through a list of these medical questions. And let me know if any of them are yes. Okay. So we got last 10 years.
All right, she's all right.
Okay. Last 10 years, we're looking for heart attack, stents, congestive heart failure, bypass pacemaker, irregular heartbeat. Any of that stuff?
Either one of us.
None, okay. And then last 10 years, we're looking for angina, stroke, oxygen, inhalers for asthma, COPD.
No,
Last 10 years, we got diabetic insulin, diabetic neuropathy, or AIDS.
No,
Last 10 years, hepatitis C, lupus, bipolar, mental disorders, PTSD, or pain management.
no,
Last 10 years, we're looking at nerve pain, addictions or drugs or alcohol, felonies or DUIs.
no,
Okay, last 3 years, we're looking at hospital visits or surgeries. So any surgeries or hospitalizations last 3 years?
no.
None for you guys?
no.
Oh, good for you. Okay. All right. So just correct me if I'm wrong, but you guys are pretty healthy at 65, 60. We've got the common medications, the diabetes, the statins, the blood pressures, but nothing major going on. No major surgeries last 3 years. We're doing pretty healthy right now, right?
No.
Okay. Well,
Catastrophe and stuff like that. I guess that's not a major surgery.
as long as it's a checkup, do they catch anything?
No, it's like what is that, a colonoscopy? Yeah, your rear end. Yeah.
Yeah, those are good to get checked because back when I started 10 years ago, a lot of males were dying from not getting that check. So that's a good thing.
Yeah, so everything's good here.
Okay, good. So there's two things that cause our rates to go up. It's our age and our health. Okay. So the nice thing is, you guys are healthy, so we can lock in a preferred rate. Okay.
All right.
And that's kind of the key is I have to tell clients all the time that, they waited too long and now it's more expensive. So always good to get the preferred rate. Okay. So grab a pen and paper. I'm going to pull up some numbers for you. Okay.
Mhm. Okay.
And give me a couple minutes to type in your data and then I'll start running the search here. Now, Jerome at 65, you're obviously going to be a little more expensive than Jacqueline at 60. Okay. Does that make sense?
Yes.
Okay. I got 65. And immediate. Okay. And we said the mortgage is 2,200. 2,200 for the mortgage, right?
Yes.
Okay. So I'm going to show you the plan that my mom has on her house. It's two plans built in one. Okay. So it's going to be one plan and then we're going to do a rider to make sure the house is paid off. So it's kind of a combo plan.
Sit down.
We're going to do 20. Okay. All right. So on that piece of paper, I want you to write down 12 mortgage payments. 12 mortgage payments. Okay. And what this is called is an equity protector. So you can write down equity protector.
Okay, just a minute.
Okay.
Legal for a second. Okay, hold on, so she gotta get another beat.
Okay. Yeah. Go help out the kid and I'll be waiting here.
Looking at your rate. Ain't you, where's your purse at upstairs? Okay, well, look for your purse. Stop the major.
Well, is it equity?
Yeah. Equity protector. It's called an equity protector.
Equity protection.
Yep. All right. You got that written down? Okay. So what these are designed to do is they last your the rest of your life. So you can write down last forever. I just lost them. I hate it when there's kids in the background freaking being noisy. It's like, are you kidding me, dude? Oh, they're calling me back. I lost you there.
Yeah, this is Jerome.
This is Ryan. Yeah.
Yeah, Brian. Okay, my phone went dead.
I thought so. I was like, I tried to call you back and it was out. You guys okay now? You got in the charger?
Yeah, we're connected up now.
Okay.
It'll put on charging anyway, so yeah.
Okay, perfect. Well, let's finish this off here. Okay. So, and then has Jacqueline by you?
Yeah.
Okay. So it lasts forever. Okay. So it never expires on you, which means it's a guaranteed payout. Okay. So all the money you put into it, it's going to go to one or the other, because it lasts forever. Okay. So that's a good thing. The prices are locked in. They can never go up. The coverage is locked in. It can never go down. Okay. Does that make sense?
Yes.
Okay. So the reason why they're called equity protectors is if you pass away, Jerome, or you pass away, Jacqueline, it's going to cover that $2,200 a month right away for you, which is your most expensive bill and your biggest asset, to buy some time. Okay. And so this one's going to cover the mortgage for 12 months and allow time for Jerome to either refinance the house to make it cheaper, do a reverse mortgage, or downsize, sell it, and go somewhere else. Okay. So the key factor is buying some time, because right now, if Jacqueline, you pass, Jerome's not going to be able to afford the mortgage payment on his own. Okay. So we want to make sure we buy some time to make good moves. Okay. So that's the one my mom has. I'm glad she does, because her mortgage is $1,500. I wouldn't be able to afford that right away if my mom died. That'd be very stressful. So at least I got some time to figure out what to do with the house. Okay. If something happens to both of you guys, then it pays out to the kids. Okay. Now on Jerome's, that policy, write it down. It's $153 a month. $153 a month. Okay. That's for you, Jerome. Yeah. That's the cost per month for yours, Jerome. Okay. And then for yours, Jacqueline, that's $96.
Oh, so it's separate. Mine is one and hers something else.
Yeah, it's all based on age. So if we did yours the same, then Jacqueline would be rated higher. So we're actually going to make it cheaper if we do it separate, and you get double coverage. So if something happens to both of you guys, it's going to cover the mortgage for 24 months. Okay. Now, this is the first plan. We're going to adjust it, but let me get you this next one too. Okay. So this next plan that people add on, you don't have to, but my mom did. And what it's designed to do is pay off the house completely. Okay. So we got state. We're going to do Pennsylvania and male, individual and spouse, female 60. And your loan amount is $276. All right. So here's the second plan. Okay. So write down 276,000. Okay. And this pays out if there's any accidental death. Okay. Any accidental death. It's 276,000. So the whole loan be paid off. Now this one, you're going to put it lasts till 80. Okay. So it only goes till age 80. Yep. So you keep in place till age 80, and it covers both of you on one plan. This one, I can do both of you on one plan. Okay. And that one is $74. $74. Okay. Now, while we're looking at both of these, we can do one, we can do the other, or we can do both. My mom did both. So the first one pays out in case you have a heart attack, cancer, stroke, accident, any death at all. It's going to pay out. It's last forever. So you're paying more for the guaranteed payout. Okay. And
It doesn't last for a year though.
it covers the mortgage payments for a year. It also has a rider on that first one that if you go into a nursing home, it's going to pay you $1,320 a month. So write that down, $1,320
For how long?
for as long as you're in the nursing home.
Oh,
Okay, because obviously one of you guys isn't living in the house anymore. They want to make sure that you're getting some money to cover the mortgage payment. Okay.
Right.
So that's called a living benefit. It allows you to access the policy where you're living. And again, it lasts forever. Okay. So my recommendation is always to get that first plan first, if you can afford it, because it pays out any death and it's a guaranteed payout since it lasts forever. Okay. And then the second one, I usually tell people is to add on, if you're worried about paying the whole house off, add on that rider for $74. And then you get the whole house paid off if you die of an accident. But
To get the second one.
you can get just the second if you want, yes. But I recommend you get,
The death, accident, any kind of death in the house is paid off.
no, so there's two ways we can die. One's of a disease, so think heart attacks, cancers, COVID, stuff with disease, all right? And the other way we pass away is of an accident, which is from injury. So think car crashes, stuff you see in the news, what have you, okay? So if you had only that second one in place and you had a heart attack or cancer, it's not going to pay out. So remember, it's only from injuries. Now, accidents are the third leading cause of death in the United States. Remember, it goes heart attack first, cancer second, accidents third. So they do happen, but you're not fully protected on that one. That's why it's cheaper, okay? So usually we can do that one only if you want, but if you can afford it, I recommend the full coverage first because you're fully protected.
Okay, so on the first one, for me and her, well, we both have to do it. I would get to do it and not her. Is that correct?
No, just one of you guys can do it if you want. So, if Jacqueline wants to just do it, then that would be $96. That would protect you, Jerome, if she dies, to cover the mortgage payments for a year. If you want to protect Jacqueline, that's $153 a month to protect Jacqueline.
Okay, so but the both of them is $250.
Yeah, pretty much. Yeah, give or take.
But that's a year. But then after a year, then you're responsible for the full payment yourself, right?
Correct. So you have a year to either sell or refinance or do reverse mortgage, but you don't have to make your $2,200 mortgage payment. Yeah.
Okay, we're not interested in that. But I mean, it's a year.
Yeah, it covers for a year. Now, that's what the hospice guide recommends. Have you ever had someone go into hospice?
Yeah, I'm familiar with the hospital.
Yeah, they just say don't make any major decisions your first year after you lose someone. So this is going to cover your most expensive bill and your biggest asset, buy you guys some time to make good decisions.
So is this, okay, like 5 years down the road, it's God forbid if something happened, then this will kick in like the plan one, it'll kick in, but it only lasts for a year.
It will.
So it is $153, so it'll be like about 13, 14. It'll be about 13 or 14 $100 that would be paid into there. About $1,500 would be paid. No, pay the mortgage. Okay, it'll be.
Yeah. So if you had your mortgage payment up $2,200 for a year is $26,400. If that's what you're trying to do, but that's how much it costs to live there for a year. So that would, pick up that big bill, buy you guys some time to make good decisions on the house because you're not,
It would be $1,200 a year to be on this screen. It's about $1,800 a year to be on there. But if it happens 5 years down the road, I'll be paying, and then I'll be able to collect for a year. But after that, it'll go back to the same thing. I'll be responsible for everything.
Yeah, it does build cash value and it lasts the rest of your life. So it's really the only insurance that lasts forever, right? So car insurance, we don't look as an investment. Health insurance, homeowners insurance, we don't get mad every year and go, dang it, I didn't get a heart attack. Why didn't I collect on that health insurance? Or why did my car get stolen or my house burned down? Right. So if things go right, which is what we want to, right? We want things to go right. We always lose money in insurance, but this is the only insurance you don't lose money on because you're going to get a payout because it lasts forever. Because there's only one thing certain in life is death and taxes. So that's the nice thing about this one is it lasts the rest of your life. It always is going to be there. It's always going to pay out. Does that make sense?
Yeah.
Yeah.
So.
Yeah. So really, it's the only insurance guaranteed to pay out is the permanent coverage, which is what this one is. Okay. Now, if these costs are too high, what we could do, Jerome, on yours, I think this might actually make sense because Jacqueline's bringing in a little more money right now. So, you're probably going to be in a tougher spot. So let's try this out. I think this might be a smart move for you guys. Let me see what this would bring it down to. I want you to write down 9 months of mortgage payment protection instead of 12 months. Okay, so 9 months. And that's going to be the equity protector. And for you, Jerome, we can lower it since you're a little older and you make a little less right now. So on the 9 month one, if we do a 9 month instead of 12 month, that's going to bring you down to 115, Jerome, instead of 153. Okay. It makes it a little bit more affordable. So she wouldn't have a full year, but she'd at least get the 9 months covered.
Yeah, but it's still the same thing because it's just 9 months. It's 9 month mortgage plan, so it's 9 months. It's 115, but you have to keep on going. You still got to pay the other 3 months somewhere else, right?
Yeah, I mean, it's either
You have to buy over to the next year.
correct. Yeah, so
15 it'd be 15 months the next year, or however it is. But you got three months, and every year is 3 months every year. So it's about the same because it's just breaking it down.
Yeah. No, yeah, you're right. It's just obviously the more we put into it up front, the more time we get later on. But a $276,000 full coverage policy at your age would cost you $800 a month. So that doesn't make sense. So, most people do the equity protector since they last forever and they're protecting their biggest asset by covering their most expensive bill. Okay. So just kind of the amount of time you want to do. So my mom did an 18-month one. She was a female, got it at 65. So it was still affordable. But, obviously the longer we wait, the more unhealthy we get, it gets more expensive too. Okay. But
you take the paper say she passed away.
I'm sorry, one more time.
Say your mother passed away.
No, my grandma did. She had a 24-month one on her house, but she ended up selling it in 18 months and using the equity to go to like a retirement place. My mom did an 18-month on her house. That's just to protect me in case she dies. So I got some time to figure out what to do with the house because I have to sell it or refinance it to my name. But, at least I don't have to worry about the most expensive bill right away. Okay.
So she got 18 months into this claim, you said she got both of them, but she only took it off for 18 months.
My mom did the 18-month one. My grandma and grandpa had the 24-month one. When my grandpa passed, she sold the house in 18 months. She thought she'd stay there, but she ended up using it to go into retirement place until she died. So yeah, it just
okay, so we got these figures. So somebody else will be calling us the see if we want to lock them in, or you the one that
yeah. So basically, yeah. I know that you guys were a little distracted up front earlier, but what I was trying to say is it's not something you can buy. You have to be approved for it. So if you see a need for it, like most people, then my job is just to help you put in that request for the approval. And then the insurance company gives us an answer in about 3 to 7 days if you're approved. And then you'll have 30 days to adjust your policy up or down. Okay. And then if you don't want a policy, what's that?
It's just the policy up and down.
Like if you decided you wanted to, get the 9-month one over the 12-month one, or if you wanted to maybe get more coverage on the accidental, it goes up to $500,000. Maybe you want to get less coverage. So you have 30 days to adjust your policy.
Oh, okay, I understand.
But the first step is just seeing if you can get approved or not.
Right.
Right. So the question is, I mean, if, something happened to you, 2 years from now or yesterday or, 10 years from now, would it put you guys in a better financial position to not have to worry about your mortgage right away and, have some time to figure out your next moves?
Right. Okay, yeah, well, yeah, let's see what people say, or
You want to see if you can get approved on it?
yes.
Which one are you liking right now? Which one do you think is a good starting point, at least?
You would have to really sit down and talk about it, and it might be one or the other, her or me, probably once 12 months, you know what I mean?
Do you think the 12-month one for probably both of you guys, and then we'll think about the accidentals and add on later?
Maybe something like that.
Okay.
So the accidental is $74, right?
Yeah, that covers both of you, but again, it goes till 80, not forever, and it's only accidental. So my recommendation is always get the full coverage first, because it covers any death, lasts forever, and it has a nursing home rider built into it too, protect you while you're living, as well. So the long-term care is usually pretty expensive. So to have that in there is pretty good.
So just the first one is 153 plus 96. About $250.
Yeah.
About $250. So we'll yeah, I think you go on and put it through, and we'll talk about this. The exact how this we could do it to fit our,
Right. Yeah, but keep in mind, if you guys get both, you guys each have a plan. So let's just say something happened to you, Jerome. It's going to pay out to Jacqueline. She's got the 12 months to figure out to do next. Jacqueline still has her plan in place to pay out to the kids, or she can cash it out because they each build cash value. So anytime you don't need it, you can cash it out if you want.
Right.
Okay.
Okay.
So each of the plans do have cash value. If you win the lotto, don't need it, cash it out, or you can keep it in place to go to the next in line, which is the kids. Okay.
Right.
Okay. So for the starting off point, Jacqueline, you have any questions on this? Is this making sense?
Yeah.
Yeah, it's just basically an equity protector. It's protecting your growing equity and making sure you guys got time to make smart moves on your investment, which is your house. Okay.
Okay, so I got like almost $3,000 for a year with this first plan.
It's gonna pay $2,200 a month for 12 months. Is that what you're asking?
Now, it's like $249 a month for her and me, because mine's 153. Hers 96. That's $249 times 12 is 2,988.
Yeah, and it's gonna get you guys close to 53,000 in coverage. Yeah, if you want to add it up that way, but yeah. So, about 83, years old or so, you guys probably break even, but it's guaranteed to last forever. We want to live a long time anyways, and then we always have the guaranteed payout. Okay. So yeah, it's like 84, 85, somewhere in that range. So you go past that, you might lose $2,000, but you're still gonna get your 26. And then, with all insurance, if you live a really long time, your car insurance, you waste money, homeowner's insurance, any insurance, right? So we want to live a long time. That's the goal. Okay. So, but we just don't know we're going to die.
Okay, so let me understand. You said about 80 would probably get about 26. So what is that? 26 what?
Well, you're starting to look at this kind of as an investment, Jerome. It's not, it's a insurance in case something happens tomorrow. Okay. So the investments are like in case I live a long time type of stuff. This is going to in case I die early. I got more money than saving up. Okay. But basically around 85-ish, 84-ish is when you put in what you're going to get back, if that's what you're trying to figure out. But we don't know if you're going to live to 84 or 85. We don't know what tomorrow might bring, right?
So whatever it is, 80, 83, 84, then what I put in, and if something happens, that's what I would,
You basically get everything back you put into it, right? But from now until then, you'd always gain money versus a savings account or investment, right? So that's how all insurance works. I mean,
you said what I get back is cost of the mortgage, which is 22, 5, 12.
yeah, which is around 26,400.
Yeah.
Yeah, exactly.
It's an 80, that's what I would,
And that's the goal, right? Yeah, the goal, we want to get to that point, okay? Because in car insurance, I know I probably paid more in a car insurance than I've ever had owned a car so far. So, insurance we have because we don't know what tomorrow may bring. It's not an investment, but we're ensuring that we're going to be okay if something happens tomorrow, right? So that's kind of the major point of it. But yes, the nice thing about these plans is, they last forever. So you're going to get a payout no matter what. Right. Make sense?
Yeah.
Okay. Perfect. Well, let's start with the 12, and then you guys want to think on the accidental rider for 74, maybe add that later.
Yes.
Okay. Does that make sense, Jacqueline?
Yes.
Okay. So we'll start there, and then we'll kind of see, where, if we can get you approved on it. And then I'll be assigned to you guys. So anything you guys need, you're gonna have my cell phone number. Okay.
All right.
All right. Hold on one second. Let me get this opened up for you.